Good afternoon, everyone. Happy Monday. Welcome to our April presentation for 12 Points Business Advisors on minimizing taxes for the long term. If you don't know me, my name is Dave Clayman. I am the CEO and co-founder of 12 Points brands, 12 Points Business Advisors, 12 Points Wealth Management, 12 Points Retirement, etc. I'm joined today by my partner, Christopher Cahill, principal in our family office division. And we are going to talk today about how to minimize taxes for the long term for business owners. So for any of you who've attended one of our 12 Points Business Advisors seminars before, you'll know that we always talk about the life cycle of a business owner. People tend to think of it in phases, from the business launch and growth to then maybe you get a quantitative valuation. So you say, geez, I wonder what my largest asset is worth. And you go to a CPA firm or a valuation specialist and you ask, how much do you think my business is worth? I'm starting to think about insuring it or getting insurance on myself, if I have a partner, and making sure that everything is covered if something should happen to one of us, or you may want to be doing some estate planning, or you could be starting to think about selling. And that's where you get a quantitative valuation. It just really looks at the numbers. We believe that a qualitative valuation is really where you find out what the true value of your business is, because now you're looking at your systems, your processes, your employees. How long have they been there? Could the place run without you? How is your relationship with your customers? Are you a key part of their world? So are you what we call entangled with them? How important? Do you have recurring contracts, or are they one-off transactional relationships? All of those things will increase the value of the business to a prospective buyer. Once we determine what the business may be worth, we then go into what we call value acceleration, and that's working on increasing the value of the business while you still own it and for future sale. And then lastly, you should do a regular reassessment. Do you want to go to market, or do you want to keep growing? And then we get to harvesting, protecting, and growing your personal wealth. Now, these are laid out in phases, but really they are happening continuously across the spectrum at all times in conjunction with each other. So what we're here to talk about today is really something that comes into harvesting, protecting, and growing that personal wealth, right? That's where taxes come into play. How do we ensure that the decisions we make maximize the outcome of our life's work for ourselves, our family, and the people and causes we care about? Because taxes are going to have a big impact on the sale of your business and what it will ultimately be worth to you and those people and causes we talked about. And federal and state taxes, if you don't plan well, can consume over 50% of your sale proceeds. So what are some strategies that we can take? Well, here we've got your top 5 decisions to minimize those taxes in the long term. Maximizing your retirement contribution. And we don't necessarily mean just the $23,000 that you can put in personally, or even a catch-up, or maybe profit sharing. For owners, often because you need to be able to save between 10 and 15% of your overall income in order to be ready for retirement, sometimes you need to look at some additional strategies that can really turbocharge those retirement savings and save you significantly on taxes in the short term and hopefully in the long term as well. We're going to talk about share recapitalization. Chris is really going to cover that, talking about how you may want to give away part of the company, but you don't want to give away any control. So what is share recapitalization? How does that strategy work? Why was that helpful? What that strategic gifting looks like. Then I'll come back and talk a little bit about entity structure. And then Chris will finish us off with talking about where the ownership of the entity is domiciled. So decision number 1, maximizing that retirement contribution. Why is it important? Well, first of all, if you're making a traditional retirement plan contribution, you're deferring your current income taxes when you're typically in the highest bracket and building long-term wealth in those tax-advantaged accounts. We always talk about things like your bond interest, your dividends on your stocks, if those are allowed to grow in tax advantaged accounts, you don't have to pay, as we're the day before tax day, the taxes on that income every single year. And that allows that money to continue to compound. That reduces the taxable income today, and that's especially powerful for you as high earning business owners. We can use all the tax deductions we can get, of course. But as I mentioned, just having a traditional retirement plan may not be enough. So first of all, we'll start with number 2 there. You want to work with your advisor, whether that's your accountant, your financial advisor, whomever, to ensure your contributions are at least maximized across every plan you've got, whether that's a 401k, or that's making non-deductible IRA contributions for yourself and your family to allow that money to grow. So yourself, your spouse, maybe even your kids. A Roth IRA is appropriate for the kids. Could you do what they call a backdoor Roth conversion? So even if you make too much money to be eligible to put money into a Roth IRA in any given year, you can contribute a non-deductible contribution to a traditional IRA and then potentially Roth convert it and allow it to grow that tax-free in the Roth IRA over the long term. But that number 1 right there, evaluating whether your business qualifies for advanced retirement plans. So again, if you're putting away the maximum $73,000 a year, if you're over the age of 50, including profit sharing and any company match, that's a nice number, but it's really not the biggest number you could be talking about. Cash balance plans are a kind of pension plan that you build for yourself, and someone in their 50s can put away an additional couple $100,000 a year. If you can afford it out of your pocket, which is very important, that you can afford to give up that kind of income. It's also very important that you can do it on a consistent basis. One of the things you need to be aware of is because it is a pension plan, the carrot is that you can put away so much money. The stick that the government has is they want you to be able to do it for a number of years, because otherwise you're not really creating a pension. You might just be kind of avoiding taxes in any given year. So kinds of things that you want to be thinking about that can be big tax savings on the retirement plan side and really get you prepared for that retirement. I'm going to hand it over to Chris here for the share recapitalization.
Great, thanks, Dave. Really appreciate that. So a pleasure to see you all and speak to you all today. So as Dave indicated, this is April 14th, 2025. So we are just a day before tax day, so no better time to be talking about this. To be clear, these strategies are things that are designed for way out into the future. So we're really trying to make sure that we get in front of our clients to help them make smart decisions with their money well in advance of any sort of transactions, specifically with their business, right? Because the stuff that we're talking about here, these are multi-year strategies that are designed to really create value over a long time period, okay? So as we look at this share recapitalization, what Dave referenced before is being able to make gifts, which is a huge linchpin and component of the work that I do in the Family Office Services group here, which is to help business owners and wealthy folks move assets through the generations. Business owners love the idea of avoiding taxes, but they really don't love the idea of having control go away with a gift, right? So what we want to do is make sure that we can transfer as much wealth without transferring as much control. So one classic way to do that is what's called a share recapitalization. So if you think about a traditional corporation, you've got voting shares issued, everybody has an equal amount of votes. What we like to do is recapitalize the stock into voting and non-voting shares whenever and wherever we can. And by doing this, that allows us to take the non-voting shares and make gifts of them by utilizing valuation discounts. So this really allows us to gift assets without control, as we see here in these 2 bullet points. So it really facilitates that tax-efficient succession planning and estate freeze strategies. And an estate freeze is basically a technique whereby we take an asset and gift it / sell it to sell it to a trust, whereby we receive a note back, and that freezes the value inside the estate and the growth occurs outside. So Dave, let's kick over to the next slide here. So one of the most important things to do in a recap here is to speak to your attorney and your CPA and make sure that the different classes are going to help make sense for you and the planning that you want to do. We love to use the non-voting shares to move the value out of the estate, put them into a trust whereby the family can benefit from that. More often than not, these days, what we're utilizing are these irrevocable trusts called spousal lifetime access trusts. This is a trust whereby the grantor, say the husband, is the majority shareholder in the company, creates a trust for the benefit of his wife and children and grandchildren, makes a gift of the non-voting shares to the trust. The spouse, his wife, can get access to that trust through the dispositive provisions, through income and principal. And it's a really great way to move assets out of the estate. So in order to accomplish this, one of the other components is, one of the other seats at the table, as it were, is a valuation expert. So we're going to really need to make sure that business is recapped and that the business is valued. And that will get us into the next area, which is gifting these assets out of the estate. And while we're doing that, let's just take a quick second and understand. Dave, if you could throw us to the next slide there. Thank you. The world as it relates to trust and estate planning now and gift tax exemptions. So the Tax Cuts and Jobs Acts of 2017, otherwise known as the Trump tax cuts, are set to sunset at the end of this year, meaning that absent Congress making an elective action and taking action, the estate tax exemption, which is currently $13.99 million per spouse, or combined almost $28 million per family for a married couple, that estate tax exemption is set to revert back to in the neighborhood of around $7 million per spouse, or maybe 14. So it could be cut in half. Practitioners, experts, folks that I've spoken to are all on the same mindset that it's likely to be extended, in that we have a Republican House, Senate, and the White House. But they actually have to get this organized and get it passed, and it's going to cost a lot of money. So how they pay for it's going to be really interesting to see. So long story short, strategic gifting remains important for those of you that can afford it, and for those of you that are on the bubble of, would you have a taxable estate if it were cut in half? Making gifts now makes a lot of sense, I think, so long as you can do it in a way that's appropriate for you and the family. So again, utilizing the non-voting shares to a spousal lifetime access trust, that sort of thing, allows you to move the assets outside of the estate. The valuation's critical, as we said. One tool that we utilize quite a bit in conjunction with that spousal lifetime access trust, there's really two. Life insurance is a huge component, right? So as we articulated, putting the assets into the spousal lifetime access trust, where that goes awry for the grantor, in this case that I just articulated, the husband, if the wife predeceases him, he loses access to those assets. So we oftentimes will have life insurance in place on the spouse to make sure that there's assets there to protect the grantor. And we also like to weave in some philanthropic planning here. So with the same time of making the recap and the gift of the non-voting shares to the spousal lifetime access trust, we can also look at making gifts of those shares to trusts, whether they're donor advised funds for philanthropy, or charitable remainder trusts that can provide an income stream to the donors for their lifetime and have the remainder go to charitable causes they care about. So those are really great combination skills and tools to use. And we love to do that for our clients when they're philanthropically inclined. Some entity structure. So here we go, Dave. Let's get into this.
All right. So basically, setting up your corporation or your company, however you want to say it, how you set it up is really important. These are decisions that are going to potentially stay with you, impact your ownership capacity, impact your partnership discussions, impact your taxation ultimately. So whether you choose an LLC, now an LLC can be taxed as an S Corp potentially. It can be taxed as a C Corp. So a limited liability corporation, it can be taxed either way. A subchapter S Corp is going to flow through to your personal tax rate. So everything is going to flow through to the owner. And all distributions need to be equal to the percentage ownership that any given owner has in the company. Or a C Corp, where you can keep the money in the company, or you can pay out a dividend and you be taxed at corporate tax rates. So that all directly affects that. It also affects what deductions you're qualified for. So again, having mentioned the Trump tax cuts, there are certain professional jobs, such as financial advisor, that do not qualify for qualified business income when you are an S Corp. So there are different choices that you need to make. And again, having set a company up in 2014, not knowing there were 2017 tax cuts coming, those could have been different decisions. The other thing to think about is when you go to sell the company, there can be different implications. For example, if you were to own a C corporation and you were to decide to sell the company to the employees under an ESOP, an employee stock ownership plan, if the C corp is transferred to an ESOP and those assets, those that you receive, the money that you receive, is then invested in US securities, so think stocks and bonds, which is what most people do, or real estate, which is what most people do when they receive money, that can actually be effectuated under Section 1042 as a complete tax-free exchange for the time being. Now, obviously, when you pass, they will eventually get taxed, but for as long as those assets stay invested in US assets, that could be a tax-free exchange. Now, if you had had an S Corp, you would have missed out on that opportunity. Now, one of the things you need to weigh is, was that the right thing to do for the 20 years before I sold it? Am I only thinking about that when I go to sell it? Is that pigeonhole me only to an ESOP? It does not, but these are the kinds of decisions that it becomes really important when you're setting up the company, but you also can review and change it. So we would recommend that you want to have an annual review of that entity structure with your tax advisor. I can tell you a story. We had one client who sold his company and he was able to classify as a C Corp under QSBS, qualified small business stock. And that allowed him to actually take the first $10 million of gain as tax-free. So lots of different things that you can do, lots of important things to understand. So just going to the IRS website and checking a box saying I want to be an S Corp or I want to be a C Corp is not enough thought. So you really need to go into it and plan, and you should be reviewing it. And there's an option, maybe a conversion from an S Corp to a C Corp or a C Corp back to an S Corp. They could yield long-term tax savings. So as you start to think about the tax world, as new laws get passed, likely at the end of this year, as Chris said, be active in your thought process and decision-making with your attorney, accountant, other advisors, so that you're thinking about all angles of the entity structure you've chosen. Apologize for the frog in my throat. All right, back to you, Chris.
Great, thanks. So where the company is set up impacts a huge component. It impacts the taxation tremendously, obviously, right? Like Massachusetts is a high tax state. It's historically been so. It's even more so today in light of the mass millionaires tax. So you really want to be thoughtful about where you're doing business. This has resulted in a lot of people setting up businesses in jurisdictions like New Hampshire or Florida, Texas, where there's no state income taxes. But obviously the ownership interest and how you hold it makes a big deal and a big difference. And there's been some really interesting case law. I mean, as I just articulated, people are leaving these jurisdictions, whether it's Massachusetts, New York, California, and going to other jurisdictions to avoid taxation. Those states that are losing those residents are doing everything they can in an effort to try and recoup and claw back tax money. So, those of you that are contemplating a move, really make sure that you're dotting your I's and crossing your T's and doing all of the things necessary in order to make sure that that transition and movement is effectuated appropriately. Talk to your attorneys, your trusted advisors, your CPAs, to make sure that what you're trying to do is going to result in the benefit and the results that you're looking for. One case that recently came out through Massachusetts was through the Mass Appellate case, the Mass Appellate Tax Board. It's a case called Welch versus Commissioner. This case is really, really interesting because in essence, what happened here is the taxpayer Welch had started a business in Massachusetts, ran it here for a number of years, moved to New Hampshire, and ended up transacting the business, selling the business. And he felt as though he was a New Hampshire resident, shouldn't be paying taxes in Massachusetts. Massachusetts said, nope, we feel as though that was mass sourced income and revenue, and therefore we want our pound of flesh. So the case went through the courts, and the appellate court ruled in favor of the commissioner of Massachusetts and did assess taxation on that transaction. So that's the sort of thing that has practitioners like myself, Dave, and others concerned about where the future goes for people that have businesses that are in, again, jurisdictions like New Hampshire, Massachusetts, New York, and California. Can you extricate yourself? And they're trying to say in this case that you can't. It really just means setting up new entities. You really want to be thoughtful, as Dave said. In 2014, when he started the firm here, he had no idea of knowing that the Tax Cuts and Jobs Act would have made a different structure possibly more beneficial. So we never know what the future holds, but all we can do is plan with the facts that we have. And in many instances now, if you were to set up a new entity, you might not choose to do it in a state like Massachusetts, California, or New York. You might choose to do it elsewhere. So just want to make sure that you pay attention to those facts as well. I think there's another slide here, Dave, is there not? I think we're at the end. Yeah, you're right. So the best tax strategy starts years before. So as I was articulating at the beginning, we really, really want to be talking to all of you years in advance of any sort of transactions. And you really can't start planning early enough. Thoughts on that, Dave?
Yeah, look, we always say that you have one goal as a business owner, to make sure that your business is valuable, attractive, and transferable at any time. For the good, someone comes and wows you with an offer you weren't expecting, or the bad, something happens to you and the business needs to leave your family, whether you passed away or become disabled or whatever that might be. And so planning ahead and making sure that you are optimized to be valuable, attractive, and transferable includes planning your tax strategy ahead so that you know what the outcomes will be for you, and having that conversation on an annual basis just to make sure, have any laws changed? Is there anything I should be thinking about? That's good planning. And good exit planning is just good business planning. So a lot of people get afraid of exit planning because they are so tied up with their identity in the business, but it really is just good business planning overall. So that's what we had for you today. Chris, unless you had any final thoughts?
Plan early, plan often. Thanks, everybody. Appreciate you spending time with us today and look forward to talking to you soon. Thanks, Dave.
Thanks, everyone.